Okay, this is Professor Zer again. I'm going to go through this quickly. Unfortunately, I have to because my disk space is running out. And this is the final video. This is on an acquisition with a bargain purchase option in which there is no liquidation. So you're going to have the situation we're going to be dealing with, looking at the PowerPoint, will be that situation right there where you have two companies and one controls the other one. Okay, let's get right into this. And let's get right into this. Okay, so we're dealing in situation number 4 in a sense, and from the so this combination is going to be very much like this one here, almost exactly. The final result's going to be the same, and the setup is the same. The only difference is in this combination there's going to be no liquidation, so there's going to be no journal entry number 3 down here. So we're not going to have this big third journal entry. We're going to have a consolidation instead. So get the detective out here. Okay, so we're going to have a consolidation instead. Okay, so let's see what we can do with this. Let's start with Goodwill. Okay, I've already done the Goodwill computation, and I've done that. Let's see here. We got to go here. No, I have not done the Goodwill computation, but I have done it 3 times. So I'm going to go ahead and rush through this, but the Goodwill computation, actually I have, is exactly the same as in this sheet over here. Goodwill is negative $45,000. Okay, and the big difference between the two examples I've been using is that in here I've lowered it to 625, so you end up with a negative goodwill of 45,000. And having done it gives me some opportunities to at least emphasize this right here was paid in cash. So your cost, go up here, Pelican pays $625,000. So that was paid in cash. Let's see now. The net assets are common stock, additional paid in capital, and that amount right there, and retained earnings. The fair values all come from this fair value column here, starting with retained with accounts receivable. So all I did was these fair values come from the fair values for all the assets, and the notes payable fair value is 180. Now the book values come from they start with the book value for accounts receivable, and I'm just recreating this to make sure I got it right, by the way. Then we can copy that down up to note payable, and the note payable fair value or book value is 200,000. Okay, now I'm going to go over this for a second to make sure that you know where I got this. The rules are for assets: if fair value is greater, subtract; if fair value is less, then you add it back. So if you just take a negative difference between the fair value and the book value, that'll give you the number you need for all your assets. So we can just copy those down here. All the assets, those look good. And the note payable, the rules for liabilities are if fair value is greater, add; if fair value is less, subtract. So we are just going to subtract those two, we get 20. And if we sum, starting with this difference here, you'll get your negative 45. So that's how I got that. Now the 625, these two journal entries, now move down, and the parent, I'm going to erase all this so I can do it for you again. We'll see if I have enough time for this. Okay. And we'll erase all this. I'll recreate all this for you. So you see how I got it? That's fine. Okay, so the parent, first it records its It's goodwill, calculates its goodwill, and since it's negative, since its goodwill is negative, you don't have goodwill anymore. You have a bargain purchase gain, which is negative. You have a bargain purchase gain when you have negative goodwill, basically. Then the parent has to record two entries on its own books. The first entry it has to record on its own books is the investment entry. Okay, so it's going to record the cost of the investment at $625. This debit to investment must always equal the cost, the top of the goodwill calculation. Okay, so we got $625 right there. Okay, next we have to pay our expenses, and we know that our expenses coming up here were equal to $140, and that's equal to $140. Okay, then the parent cannot make a liquidation entry, and the reason is it's not liquidating anything. So in a sense, the consolidation takes the place of liquidation. But you've got a little issue here because the parent already made two entries on its own books, so you've got to update its balance sheet for these two entries, then combine the two financial statements into consolidation. The consolidation entry I'm going to put here. Consolidation is just a worksheet, just a separate worksheet. Okay, so from entry, I have entries 1 and 2, and they're simple entries. In entry 1, you'll notice I had a debit to, this is entry 1, $625 to the investment account, and a credit to cash for $625. Then in entry 2, I had some expenses, which I'm disclosing to retained earnings. In entry 2, I had a debit to $140. That's supposed to be a debit to retained earnings, by the way. And then I have a credit to cash for $140. Missed a line there. No big deal. Okay. So what's happened is the parent started this balance sheet here. This balance sheet here, which balances at $2.8 million, is the same as this balance sheet up here. So all I've done is I'm going to take the parent's original balance sheet and update it for two entries which it's made on its book. So this is the investment entry and the expense entry. So this cash is equal to 150 minus 625 minus 140. This number is equal. That number is equal. That number is equal. Buildings are equal. No adjustments to those. Equipment is equal. And the investment account is actually $625. You created the investment account because you invested in stock. So on the parent's own books, it's showing that it has invested in a stock. Now, at this point, you don't see any entries to goodwill, so goodwill is 0. So we are going to sum these up, and we're going to see what we get. $2,660,000. That is the parent's. Assets on their own books out of the parent's accounting system. Okay, and we can see that pretty much, neither one of those two entries touched any of these liabilities. So we've got additional paid in capital the same. Retained earnings did go down because of the expenses, 360. So got a sum here, and the sum is $2,660,000. Okay, so those are the parents. What we're going to do is take the parents' financial statements after having adjusted for the fact that the parent made an investment and paid some expenses. So that we've got to make sure, especially that having an investment account there. And then these financial statements here for Seabird, all these financial statements here for Seabird is they are copied. They're just Seabird's book value financial statements from up top. You can see that it's 760 and 760. So those are 760. So what we're going to do in a consolidation is we're going to take the parents', you could say adjusted balance sheet after you do that, after you make the investment entry, and it's basically the parents' book value statement and the sub's book value statement. And what we're going to do is we're going to combine them together. But we've got to make one adjustment. I call it C1 Consolidation 1. And I'm going to do it up here. And I want to emphasize that these consolidation entries do not affect either the books of either the parent or the sub. So they do not affect the books of either the parent or the sub. And the consolidation entries are based totally on the goodwill calculation. And what you're going to do is you're going to eliminate the 625 or 74, whatever. You're going to eliminate the investment account and replace it with all its different pieces. Now, its pieces, actually you're going to eliminate some of the stuff too. Now, I want to emphasize that this 300,000 here is common stock. The 70,000 or the 50,000 is additional paid in capital, and the retained earnings, 170, are retained earnings. So you've invested 625. 520 of that is equity, and the remainder is all these adjustments and the bargain purchase gain. Okay, so I'm going to go ahead and write those amounts down. So we've got common stock, entries to every item in the goodwill account. Additional paid in capital. We've got retained earnings, okay? And the rest of these are, I'm just going to go ahead and list them down. Accounts receivable, inventories, land. I'm doing this fast because I have my disk is running out of space, and this is supposed to be a huge computer. Equipment, buildings, equipment, note payable, bargain purchase option, and the final thing in this entry is always the investment account. So what we're going to do is we're going to eliminate in the consolidation. We're going to combine financial statements, but in the process, we're going to eliminate the investment account. Okay, so common stock. We know that we're gonna write off. Basically, we're eliminating the investment against all its components, and then taking, which are basically equity, and then we're gonna actually, in that, part of the components of the investment are the fair market value adjustments. We're going to throw those in. So we're going to eliminate the equity, eliminate the investment, and do the fair value adjustments. You'll see what I mean. Okay. Paid in capital. And then finally retained earnings. Now, these are all equity accounts, so they're debits to equity accounts, so we're eliminating those. Now, what we're going to do with the asset accounts is write them up or write them down. If we're writing them up, down, credit. Writing them up, debit. Okay, so you have to be a little careful with these. The accounts receivable account, they switch signs in a sense. This is actually a write down. The fair value was less, so we're really writing it down. The signs change in this style of calculation, but it's still the best type of calculation. So we're going to credit accounts receivable because we're writing it down. Now the next three items, for example, inventory, this is actually a write up of 40,000. So we're going to debit inventory for 40,000. We're going to, and change the sign, by the way. We're going to debit land. That's a write up too of 50,000. Fair value is only 50, book value is 50. And we're going to write up the building for 50. We're going to credit equipment because you'll notice that equipment was a write down it by 50. Fair value is 250, book value is 300,000. So we're going to write down the equipment. The note payable, we're writing down the liability, so you debit the note payable for that amount for 20,000. And then finally, the bargain purchase gain. It's a gain, and all gains have credit balances. They're like revenue. Okay, and then the investment account, all we're going to do is eliminate the investment account. And basically, we're zeroing out that 625. Now, I want to make sure that this sums, and if it sums, if we have time here, our consolidation should be fine. Okay, so we should be fine. So what I'm going to do now is, first of all, this is one journal entry. And to save myself a little bit of time, I'm just going to do this. I'm just going to say every entry I make in here, there it is, C1, comes from C1. So everything I do here is C1. I'm going to go ahead and post these amounts to the consolidation. So there is a debit to common stock for 300,000. There's a debit to additional paid in capital for There's a debit to retained earnings for 170,000. Okay, and those are write downs of those are you're basically eliminating the subsidiary's own equity, because you can't own yourself basically, and you're going to eliminate that against the investment account, which we're going to make zero. But we've also got to make the adjustments for assets and liabilities. Okay, so our next entry is going to be, I believe, to accounts receivable, which is a credit because it's a write down. So we have a credit for 10,000 there. Inventories, we are writing up by 40,000. Land, we're writing up by 50. Buildings, we're writing up by 100,000. Equipment is a write down of 50,000. Okay, then we've got the investment account. The investment account, we might as well get to that one right here. We've only got two more entries from this entry. 625. We're going to write down. We're going to take out 625 out of there. We have zero goodwill because we have a bargain purchase option. And the bargain purchase option is going to be closed as a credit to retained earnings for 45,000. Okay, I'm going to sum these up. Make sure we've got everything here. Hopefully, 710. I'm missing 20. I'm missing. There's a $20,000 adjustment somewhere here. Note payable. Okay, so note payable. We had a write down of the note payable for 20,000. Okay, and then we'll sum these up too. Make sure we get 730. Okay, so now we're ready to finish our consolidation. And I hope I have enough time for the logic. For assets, you're going to take Pelican plus Seabird plus the debit minus the credit, and that should give you your final balance. If you have a big negative balance in cash, don't worry about it. Okay, you know, the management would have to, but right now, don't worry about it. Okay, so I'm going to go ahead and copy these down and check them against my numbers that I have. Okay, so you've got negative 585, 270, 640, 550, 1,300,000, 750. There's a big important part. Your investment is zero and your goodwill is zero because we didn't have goodwill. We had a bargain purchase option. So anyway, your sum of the assets is 2,295,000. Now for liabilities, you're going to take the parent plus the sub minus the debits plus the credits. Well, you got 340 there anyway. Let's go ahead and copy this down. And we'll sum this up. And you will get 2,295,000. So we're fine. A couple things I want you to notice. Number one, just like in the other example, goodwill, or the investment account is zero. There's little goodwill here. But notice our balancing total is 2,295,000. If you compare that to the liquidation where we liquidated and had a bargain purchase gain, the parent actually made a liquidation entry, and you end up with one company. We end up with the exact same balance sheet, 2,925. So the consolidation takes the place of the liquidation entry, except what you do in liquidation entry is you make a big entry, eliminate a company, bring everything over, and you've got one big company. What you do in a consolidation is you take two companies and make an entry that's kind of like the liquidation entry, but here's the trick is these entries here to the assets are not for the full asset value, they're for the adjustment, because what we're doing is we're taking the book value, adjusting, and that's going to give you fair value. Okay, and so the final result is the same, but here we end up, your consolidation, I don't have the thing here, but all these columns here are your consolidation right there. All those columns there, I don't have that neat line I did in the other one, are your consolidation right there. Okay, so anyway, I'll put this video up. I had to do this a little fast because I keep running out. It's August 5th, trying to get through these videos, and but I think they will help. And as the month goes on, I see how the course. So I'm going to start the course. I'll be able to maybe redo one or two of them that I went too fast on. But we'll be having lecture two. Anyway, thank you very much, and I will put this up.